Okay, welcome everybody to episode, I believe, 110 of my podcast here. Now, right off the bat, right out of the gates here, some of you will know that I just got back from France. Took my wife on a few-week vacation. It was our anniversary. Just got back yesterday, so I'm in a new Airbnb here. And just as I'm ready to turn on the camera, it does appear from my end, I don't know if this is what you're seeing as well, but for me, it kind of looks like there's some type of delay. It looks like it's skipping a little bit. So again, I don't know if you're also seeing that, but if I am on my end, there's a pretty good chance you are as well. So I have to push forward. I don't have enough time to troubleshoot this problem, but I will try to stay inside the screen share as much as I can. So you're not actually looking at me skipping and, doing this slow motion little wavy stuff. So it is what it is. We've had technical difficulties in the past and, nothing really new here, but this is, basically life on the road. I'm basically on the road at least half the year in many, many different countries, and you get what you get. You kind of deal with it as it comes. So I will just, like I said, try to stay off this screen as much as possible. But for the Q&A section, which is typically about 40 minutes, you are going to have to stare at my dumb face when I'm doing this. So otherwise, we are going to do a short presentation here. If you're new, welcome. What I typically do is I'll maybe do 15, 20 minutes of a specific topic, sometimes two topics. I'm going to stick to one today because there's a live trade we're actually going to open. And all of you following along at home, you might want to open it with us. So I will stick to just this section. I'm going to talk about the difference between iron condors and calendars really quickly. And then I'm going to basically highlight the difference when you're opening them, because there's one small difference that subscribers of my community have to be aware of. Now, if you're not in the community, of course, you can appreciate it as well. But yeah, we will also execute a trade. And then feel free to start putting your questions in the chat. I'll get to those in about 15 or 20 minutes. So without further ado, hopefully this looks a lot better on your end than it does mine. But yeah, let's get into it. Okay, so like I said, let's try to actually stick to a screen share as much as possible here. Hopefully this looks a little better on your end. So iron condors versus calendars. The reason we're talking about this subject today is because we did in our VTS portfolio take a new trade within this iron condor strategy. So this is our 4 strategies that we have in our overall portfolio. They're all different. They function a little bit differently. These 3 are mostly tactical rotation strategies benefiting from either strong uptrends in the market or strong market crashes, with moving to safety positions when the markets are just chopping around sideways. This position here for the iron condors, this one sort of fills in a hole within the portfolio where, tactical rotation and trend following strategies, they do have a difficult time making money in difficult markets. Obviously, you do need a little bit of a trend. And so the iron condors, being a more market neutral strategy, can fill in that gap a little bit. So this is what we're talking about here. Now, I will, of course, mention that for more aggressive investors who are really chasing a much higher rate of return, sometimes they do like to skip the 2 strategies that, historically speaking, I've been trading all of these for many years now, 10, 15 years. Historically speaking, it is tactical volatility and defensive that are the higher returning strategies. And so, look, if people are super aggressive and they don't really care about drawdown reduction as much, they can do what we call the absolute return portfolio, and then they wouldn't be trading the iron condor. But stick around anyway and listen to it because it is interesting stuff to me anyway. I've been trading iron condors for 20 years, so I absolutely love them. Now, the first thing that I want to do really quickly is basically just touch on the reason why we trade iron condors in the first place. It might not be so obvious to people. Most people are stock traders. They're doing very basic, rudimentary option strategies like covered calls or, buying leap options. I mean, all the things that totally don't work, but all the trading gurus online will swear that they do. They do that because it's very low hanging fruit. It's easy to convince people that there's some type of income going on when obviously it's just nonsense. If you've watched a lot of my other videos, you will know that by now. So, but iron condors actually do function pretty well. And they, like I said, they fill in gaps in pretty much everybody's portfolio. I think that most people could benefit from some market neutral exposure. So the iron condor is basically shaped like this after you construct it. It's a 4-leg option, but don't worry if you're new to options. It's all done in a single transaction. Basically, it just gets built for you as an Iron Condor. So when you click on Iron Condor, it will build all 4 legs for you, and it will all look like this. But, it might look a little confusing in the beginning, but trust me, it's not. But essentially why we're doing this is because, if you think about what's happening in the market, let's take what we're going to be trading today, which is gold. Here's the price right now. And, obviously looking forward, we don't know where the price is going to be. Right? So this is expirations going out in time, those red hash lines. We don't know where it's going to be here. This is actually the cycle we're going to be trading. But what we do know is that we would probably expect that, as I always say, the best indication of what's going to happen tomorrow is what's going to happen today. You can always pretend that you're going to play the contrarian and you're going to catch that reversal exactly right. But typically markets reflect what they are currently doing. And that actually plays out further in time too. Most of the time, markets are just chopping around in a reasonable range. So what we're trying to do with this strategy is we're trying to basically just catch whatever's coming going forward, knowing that we can't really predict the direction. Maybe things get really good, maybe everything in the gold market stabilizes, maybe it doesn't, and it crashes down. But we know that there's a pretty decent chance it's going to land somewhere in there. That's what we're trying to do. So if you flip this shape on its side, you can kind of get an idea for what we're doing. This is the Iron Condor. It throws out a really wide net and it catches most future prices. Now, obviously it can go higher or lower, but a pretty high percentage of the time we're going to catch that right. Now, the Iron Condor itself, you don't have to know these Greeks exactly. You just have to know them sort of conceptually speaking. I don't want to math it up here. It's very basic stuff. But the only Greeks that I really focus on are delta, theta, and vega. Now, this is important because this is the subject of today's live stream, why we are eventually going to introduce what's called the calendar option. It has to do with something within these Greeks. So the first one, delta. Delta just refers to the price direction in the market. So, specifically, delta shows how the options value changes given a $1 change in the underlying stock price. So basically, as the prices are moving around, keep having to move this window. Let's put it over there. All right. So basically, as the prices are moving around, you can expect that this trade will bounce somewhere in here. Up or down doesn't matter, but we do kind of want it to stay in this range. That's why whenever we're talking about Iron Condors, we call them neutral. We call them market neutral. Delta neutral trades. Up or down is fine, just hopefully not very much. Theta is basically the sensitivity to time. Theta shows how an options value will change. All other things held constant. That's important. The Greeks are not, exact, measures of anything, but they're just good conceptually, of the passage of one day. So this time, it shows that, over time, this Iron Condor will make a little bit of money each day. The longer the price stays in this middle range, you'll just pick up a little bit of premium every day. That's how theta works. And the last one, this is the important one today, vega. This is the volatility component. Vega shows how an options value will change given a 1% change in volatility. Now, Iron Condors are vega negative. This means they are essentially short volatility trades. They benefit as volatility declines. So if you open an Iron Condor, for example, in mid to high volatility, then there's a pretty good chance that it's going to have much wider wings. That's the first thing. And there's just a better opportunity for profit because volatility can either stay where it is or it can likely come down a little bit and you can make your profit. However, this is where it gets tricky because what if volatility is already low? From that point, it's actually hard to imagine that it's going to just continue getting lower and lower. So the Iron Condor kind of gets squeezed out and the margin of error actually shrinks a little bit. The wings get narrow and your trades are actually more susceptible to losses. So now, finally, the punchline, this is where the calendar option comes into play. These are very, very similar trades. They look different. This one looks like this one, shaped like that, but actually they're very similar. So the first thing, they are both delta neutral, right? Both of them will profit if the price stays in this sort of middle range, not moving too far up or down. Now, you do have 4 or 5% either way. It doesn't have to pin on that price, but they are both delta neutral. They're also both theta positive, which means, again, if the price hangs out in that middle range, you can just pick up a little bit of profit each day. And then, 20, 30 days down the road, maybe close the trade for your gain. The third one, though, the vega component, you can see this one says positive and this one says negative. This is why within our iron condor strategy, we actually use both iron condors and calendars, depending on the volatility environment. Because if volatility is already low, then calendars will actually be a little bit better. So let's take a look at two trades here. The first one is this iron condor. And let's go through the Greeks, just so you can see this visually. So the first Greek we talked about is delta. This pink line is basically what we're looking at. You can see it's delta negative over here, this minus 19. Over here, it's delta positive, but in the middle, it's basically zero, right? If we highlight this calendar option, which is basically a calendar on the exact same underline, same expiration, this delta, same thing. Delta negative here, delta positive here, delta neutral here. These are both the same delta exposure. For theta, we've got a theta positive trade. Remember, iron condors profit from the passage of time. This number up here is a positive number. If we highlight the calendar, again, same thing. This pink line, positive number. This is a theta positive trade. The third one, vega, this is where it's different. So you can see for the iron condor, it's a short volatility trade, vega negative. That pink line down here, you can see minus $25. If volatility declines by 1%, this trade will make $25. Again, all else being held equal. Of course, the Greeks are not an exact science here, but you can see it's actually a vega negative trade. Well, what happens if we click the calendar? Now you can see it's different. This pink line is above the zero. It's actually a vega positive trade. This has to do with the structure that we are building here. If you look at what's actually happening with an iron condor, the inner strikes are short strikes. They're closer to the money, which means they're going to be, essentially the stronger ones. That's why when the passage of time, if volatility goes down, those ones are going to bleed. A calendar is structured differently, where the short strike is basically the near month, and then the long strike is the far month. But calendars are opened for a debit, meaning you pay the premium to open the trade, and the long strike is a higher price than the short strike. The short expires much sooner, so it's going to be lower premium. And that's why as it's moving around, anything that the market is doing, it's going to affect the higher priced option a little bit more than the lower priced option. So of course, the calendar is going to be less sensitive to that negative vega of an iron condor. Now, I wouldn't say that they are strongly vega positive, right? Of course, if you wait till expiration, that front month is going to be completely gone and you're still going to have the back month there. And then the vega is going to really kick in strongly because that's going to be a single leg long strike. But having the short open, of course, it moves pretty quickly. It's sensitive to short-term movements. And so it's not hugely vega positive. But what we can say is that it's definitely more vega positive than an iron condor, which makes it very useful to open during low volatility environments. So that's the distinction. Essentially, all of that summarized into we open iron condors during mid to high volatility and we open calendars during lower volatility. Now, little bit of a detour just to let everybody know, I don't run my live streams on, advertising and all that stuff, but there is, for VTS subscribers, a 30 video iron condor course that you can go through. It's over 5 hours. You could probably get through it in a weekend pretty easily, maybe a week or two, but there is a full course here. If you want to see some of the individual subjects here, they go on for a while. We talk about the rules of engagement, the trade instructions. There is a spreadsheet so you can track your trades and log. Hopefully everybody gets their first 25 trades in, and then they can start to analyze their past performance, maybe improve a little bit. And then we get into single questions, why do we use wide wings? Why do we use longer dated contracts? This is important. What is high volatility? What is low volatility? I'll get into that in a second. But lots of examples, how to make your large account. If you're trading, $1 million or a couple $1 million, you're probably not going to want to use ETFs at that point. You might want to use the indexes, things like that, how to diversify. But you can notice down here, I start getting into the calendars. This is kind of the important distinction here. One of the rules of engagement that we actually highlight is the fact that Where are you? I know I put it in here somewhere. One of our rules of engagement, there is a full video on this that goes through everyone in detail. I'm just ripping through this as fast as I can. But you can see one of them is iron condors mid to high, calendars for low volatility. And there are slight differences here with the calendar trades, but that is one of the rules of engagement. Now, what I want to just quickly, I said it's not an advertisement, but if you're wondering actually how to get access to this, you're going to go to volatilitytradingstrategies.com. You're going to click the subscribe button, and everybody gets a free 2-week trial. Like I said, it's not even going to take you 2 weeks to get through the course. And then from there, you can kind of poke around at all the other courses and the other strategies. Man, maybe you want to stick around, it's entirely up to you, but claim your free 2-week trial at least and check out the Iron Condor course because, this is something that most people obviously would charge a lot of money for. This is just included and it'll get everybody up to speed on everything you need to know about iron condors. Now, what is mid-high volatility and what is low volatility? This is an important distinction. So one of the things I do, and of course there is a lesson in the course talking about this, but one of the things that I do, I have what I call my volatility barometer. This is all my volatility metrics, currently about 13, combined into a single value. So if we go to today's email, this is my email that goes out to subscribers every day. You can see there was a new trade. We're going to take this trade live in a few minutes. And of course, you can take it with us if you want. But this is the volatility barometer value for today. You can see that, 0 to 100. Volatility right now is about 32%. So I would call this sort of in the low range. But that is actually what we're talking about. How do we actually decide? So if you do have access to the volatility barometer, I suggest you use it. This is the best measure of volatility that you will find. There are a couple other ways you can do if you're not a paying subscriber. You don't have to pay me money to benefit from my work. But what we can essentially do is if it's above 33%, just favor iron condors. If it's below, favor calendars. This isn't a game-changing difference. Like I said, iron condors and calendars are quite similar, but it will give you a little bit of an edge. And of course, profitable trading, it never comes in any slam dunk differences. It's always on the margins. It's just making little improvements to your trading along the way. And when you add up 10 small edges, you end up with a highly profitable strategy. So this is one of those edges, understanding when to open calendars and when to open iron condors. So of course, you can do that with the barometer. If you don't have access to it, of course, everybody has access to the VIX index. It's not a very good measure of volatility, to be quite frank here, because remember, the VIX is simply a statistic derived by options activity on the S&P 500. It's something, but it's certainly not a comprehensive measure. And so, but if you do have it and that's all you have, then of course you can just divide the VIX this way as well. And I would just suggest make it super simple. The 30th percentile on VIX values going all the way back to 1986. You notice I included the Black Monday 1987 there. VIX actually went to 150, topped out at 172 intraday that day. So anybody who thinks the VIX stops at 100, remember, it's not an actual practical tradable value. It's a statistical value. And yes, it can go over 100. But anything below 15.19 is the bottom 30th percentile. Anything above 15.19, you'd favor iron condors being mid to high. And the third thing you can do, if you want to use this metric as well, if your trading platform makes it easy to view, you can use what's called the percentile rank. It's typically a 52-week percentile rank, but you can basically, if it's below the 33% IV, calendars. If it's above, iron condors. Now, for Thinkorswim, I can tell you where to get this value. So you just type in any ticker. You can see this is the GLD right there. Just go to the bottom in your Thinkorswim platform, go to today's option statistics, and there it is. So right now, current IV percentile, 18%. Now, I just want to mention really quick, this can be a little bit deceiving because, of course, it's only a 52-week measure. So if, for example, you were in a period with crazy low volatility for a whole year or really high volatility for a whole year, it might actually not represent a number that's accurate long-term, right? They might be skewed saying, look, volatility might be actually super low right now, but over the last 5 years, that might not be the case. So just be aware that when you're talking about a 52-week percentile rank, it might not reflect longer term values, but this is fine and you can use it. Again, volatility barometer being the best, but any one of these is also fine. Now, before we get into the actual trade, I just want to mention the strategy itself. The Iron Condor strategy, we leave space for 3 trades to be taken at the same time, up to 3. We rarely get to the third, but it is what it is, because you're always better off trading multiple smaller positions with higher trade frequency than you are trading one giant position. I just want to check really quickly here that nobody's yelling at me in the comment section here that I'm not even recording or something dumb. Lip sync in slow motion. Okay, so you're seeing it as well. You look lower resolution. I'm sorry about that. I don't really know what to do. Anyway, let's get back to what I was saying. Hopefully I can get my train of thought. We allow for up to 3 positions at the same time. Now, the first position will always be equities, right? It will always be something to do with markets. I always trade index options. So basically, here's a list of the top 20 ETFs, the most liquid options. We will always be sticking to the SPY, the Qs, or the IWM. That's when we're trading equities. The second layer, typically speaking, will also be equities. There's a couple of rules within our strategy and within the rules of engagement. You would learn that in the course, that perhaps you can start diversifying away from that, or the second level would be equities. The third level would almost certainly be something else. And the something else, again, we of course need high liquidity. We need high AUM. We need good underlines to trade. Otherwise, your executions are going to be really poor. There's a lot of, quote unquote, trading services out there that are essentially benefiting from the fact that they're trading smaller stocks and indexes with, low volume. They front run the community. It can really affect things. Entries and exits get all messed up. They're posting performance that looks just staggeringly good, and then you follow their trades and you get nothing even close to what they report. I'm sure people have experiences with that all the time, but the way that you can get away from that is, of course, we only trade the most highly liquid. So there's no front running the SPY. It's just a massive ETF, and all of these are the ones as well. So basically the top 2 go-tos for me personally, I would always default to GLD gold or TLT bonds. Those are sort of what I'm looking first to fill in this level. And then if those are not looking great, we do actually have a rule here that we don't take new trades at strong trend points. So just for example, one of these you can see is, let's pick out one that I know is going to make my point here. Let me see. Let's see what XLF. Have I looked at XLF in the last few days? XLF. Great point. So this is a strong trend upwards, right? What I would actually want is a little bit of a pullback before you execute a trade. You don't ever want to trade things on strong trend points. Let me see if I can actually highlight something even better here. Rules of engagement, where are you? Lesson 6, rules of engagement. Let's look at this one. I know there's a visual here. So this there's me yapping. There's got to be a visual. So yeah, essentially what we're doing is you don't want to open anything on a strong trend upwards or downwards, because of course the Iron Condor profits from stability, and it's actually better that you wait for some type of small reversal. So I've highlighted some of the strong trend points. These are not places that you'd really look to enter any market neutral trades. What you're actually looking for is just little changes of direction. You can see this one, strong downtrend. Just wait for a few days of the market going up so it gets back closer to the recent midpoint. Here's a strong uptrend. Don't open one at the peak there. Wait for, 2-3 day pullback. You're just going to have a slight edge. Again, like I was saying, 10 small edges add up to big profit. And one of the edges is don't rush into the market and open a market neutral trade right there. You wait for a few days for a little bit of a pullback, get it more towards the center of this range, and then go ahead and fire something off. So this would be an example of something that, while it is on the, highly liquid ETF list, you wouldn't want to do that. I would imagine HYG is the same thing. There you go. Actually, massive pullback there. So that might work, but gold, the reason I'm taking gold today is you can see it's actually very midline. So opening a market neutral trade here would work. TLT, I believe, no, TLT is probably going to be ugly. Yeah, there you go. TLT is just bad. I would definitely want to wait for something sort of more to there and then go ahead and execute. So today, our target will be the GLD. But the point is, diversification matters, and going to gold and TLT is always kind of a good idea. Small trades, high frequency, you're going to have way more success doing that. So let's get into the actual trade. Now today, let me try to put you guys through the misery of watching me, wavy hands. I can see it skipping big time on my end. Hopefully that's not the case, but there's basically, like I said, iron condors, calendars, very, very similar trades. There's really an execution difference that I have to highlight here. This is why for my email specifically, I told VTS members today, if you do want to skip this trade or wait until you watch the live stream, maybe you can take the trade tomorrow, because there actually is an execution difference here. So I think the best thing that I could do is I could show you what I would do if I opened an iron condor, and then I'll just make the small calendar adjustment, because calendars are actually even more capital efficient than iron condors. So we can't use the same allocation size. I wish we could. I wish options was as easy as all those trading gurus online say it is. But unfortunately, anytime they're talking about things that are just dirt simple, as I mentioned before, something like covered calls, there's a reason it's dirt simple. And there's a reason that there's a billion free YouTube videos that you can watch in 5 minutes to learn that. It's because there's no edge there. But they'll sell it as if it is. Anyway, that's a side tangent. You get the impression I hate trading gurus. But what I think I should do is go ahead and show you what an iron condor would look like on the GLD, and then make the small adjustment. So for iron condors, we use a 3% allocation of total net liquidation value of your entire account. This is going to be the proper trading size. The last thing you want to do, like I mentioned here, it is actually a 25% allocation, right? The last thing in the world you want to do is put 25% of your capital into an iron condor. That is a massive trade. And sure, slam dunk, high fives all around if you get a winning trade. But if you get a losing trade, or if you string together 2 or 3, which is definitely going to happen, again, ignore what the trading gurus are going to tell you. You will run into periods and market environments that all of your strategies fail, and you're going to get a string of losing trades. When that happens, if you're allocated this big, you're going to run out of capital very, very quickly. So what we do is 15% of the capital is just held in a constant ETF, box, SHV, something like that, SGov, basically short-term fixed income, just keep up with inflation basically. And then the other 9% is allocated into these 3 trades. So 3% each. You can see here, strategy holds a constant 15% allocation to the box ETF. We have to do this because, of course, these are allocated correctly to the size of the overall portfolio. So iron condors, and we've got one open right now on the queues, 3% of total net liquidation value. So all you would do, let's just say a $25,000 account. Where's my calculator? $25,000 account. And again, this is your total net liquidation value. So let's say you have $25,000 of total capital to trade the VTS strategies. All you do is take 3% of that. You have $750. I don't know if you guys can see this calculator. In my little mini window here, it's not even showing up. I got all kinds of technical difficulties. Anyway, I'll read the numbers out just in case you can't see these. I won't know until I watch the live, the rebroadcast. But $750 for this iron condor. All you do is take $750 and divide by the maximum loss. So the maximum loss of an iron condor is the strike gap, which in this case is $5, $3.25 to $3.30, minus the premium of $1.14. So you're talking about $3.86, right? So you just divide by $3.86, and in this case, 1.94. This is that tricky little range, 1.94 contracts. With options, you can't trade partials. So I always just say round down and you'd open 1 contract. Now, just for this, I want to get it slightly closer to the calendar. And let's assume you had more than 25,000. It would be more efficient, but let's just give you 2 contracts. But that's essentially how we size them. And then we use a 50% stop. So all that is 50% of the premium. This is very easy to calculate, right? 114, 57 cents times 2 is $1. It's 114 bucks. So the stop losses for this trade is right there, and let's take it to 114. So the initial stops are here. Now this will change constantly as the market moves around, but those are the initial stops, 50% stops. But calendar options are actually much more efficient. So you can see this one here, it says calendars use 2%. That's the first difference I want to highlight here. So when you open a calendar option, it looks like this, but in this case, that would be an even bigger trade if I used 3%. So I used 2% in this case. So now 25,000 times 0.02, $500, right? The Iron Condor, we had 750 to use. This one, we only have 500 to use. And you divide that by the maximum loss, which for a debit spread is just the premium that you pay, 175. So you just divide by 175. It's 3.5, right? Is that right? What happened there? 500 divided by 175. I didn't think it was right. Come on, calculator. 2.86, we'll call it. Again, we're talking about close. I am a stickler for the math, and I literally trade to the decimal places. I've said this many times. If I have a trade that is supposed to trade at 32.40 and it's 32.41, well, 32.41 is not 32.40, so I don't take the trade. I am literally that accurate. But some people might look at that and say, I want to get a little bit of extra. So 2.86, it's technically 2. I'll give you 3, right? So now these trades are sized correctly. This trade is not going to get a $25,000 portfolio into any trouble if you string together 4 or 5 losses. But it can definitely make a big impact if you get 4 or 5 winning trades in a row. That's the point, is that you have to balance that line. Everybody looks at what you'll make if you win. I always look at what I will lose. What could happen? Let's run a Monte Carlo simulation. Let's figure out how I'm never, ever going to cost myself too much money. Then I'll worry about adding profit later on. But I always manage risk first. So this is a correctly sized trade. But the second thing we have to do is we have to adjust the stop losses. So again, a 50% stop would be a little bit much. If I get too many of those in a row, it could be a problem. So we're going to use 25% stop losses instead. Again, calendars are a very efficient trade. So 25% stop loss of $1.73, you just take 25% of that times 0.25. This is the premium that you are looking to gain or lose to stop out. And because I have 3 contracts, I'm looking at $129. So the stop losses for this trade, you know what? I'm going to use different ones. And this one's going to be at 129. I don't know. Close enough. And let's double line these for the calendars. And then the high side, let's find 129. And let's double that for calendars. So the stops for the Iron Condor are the singles, and the calendars are the double. You can see it's kind of the same thing, right? Width-wise, it's the same. It's just shifted over. The reason it's shifted over is because the volatility exposure is a little bit different. With the Iron Condor, as this price goes up, the volatility will actually come down, and that's going to skew the trade. Whereas the calendar, it just has a different vega exposure. But trust me when I say this, and there is actually, I'm sure of it, because this is actually a really visually frustrating thing when people say, well, why is your stop loss so far on the right side and it's so close on the left side? They're actually the same thing. As the market moves around, it is the same thing. So please tell me that I know what I'm talking about. Why do stops look lopsided? Why do they look uneven, right? This whole lesson is going to explain why, even though these look incredibly lopsided, they're actually the same thing. If the market moves down, this double line stop loss is going to move down. If the market moves up, this one's going to move this way. So they're actually going to end up to be the same spot. Neither here nor there. So you can see the adjustment there, 3% and 25% stop losses. Otherwise, these trades are the same. So if you're in the VTS community, that is really all you need to know, is that we're doing these small adjustments. So when I pointed to it in the email, you can see here, allocate 2% of net liquidation value to this trade. This is the one that we opened today. So if you want to see what our portfolio is allocated, of course, the market's doing great. We are short volatility, 2 times long NASDAQ, and S&P 500. It's really the market neutral strategy that we're basically taking trades here, because there's nothing we can do when the market's going to all-time highs. We're not going to be shifting anything over there. So this is the trade. Now, the only thing we have to do is actually take the trade. So, like I said, if you feel like you want to take this trade with me, if you looked at that and you thought, oh, that looks kind of easy, go ahead and take the trade. As I'm going to show you now, I'm going to execute that live. Go ahead and take one contract. So don't calculate all your things, but just take one contract and see how this thing moves around over time. I would suggest that for new people, that's probably what is best. So let's go ahead and take this trade. I'm going to do this reasonably slowly, but as I always want to point out to people, I'm a pretty thorough person. I think if you've watched my live streams and my videos, you understand it. I'm pretty detail oriented here. I like to be thorough, and it does give the illusion sometimes that this is more difficult than it actually is. But trust me, once you do some of these, it's going to be so fast. If I wanted to do this, not like it's a show-off competition, but I could execute this in less than a minute. It's really, really easy. So don't be intimidated by all the Greeks that I went over and the stop losses and all that stuff. This stuff, trust me, after 2 or 3 trades, you'll be a whiz at this as well. It's really not that complicated. So all I'm going to do, and again, I'm going to use the example coming straight from here. And given that in the VTS community, our official performance that I post on the website is always coming based off a $25,000 allocated portfolio of live trading within this TOS account, right? This is just a public TOS account. This isn't my trading account, but this is live trading. But it's just kind of something that I can show my account values. You will actually see the account numbers in a second here. I don't want to be on a live stream trying to be careful what I click on and, oh, don't show this and don't show that. So I just funded this account with some money, and so we can do this. But I'm only using 25,000 of this always, and all of our performance is live fill prices. So what we do, $25,000 portfolio. The first thing we're going to do is figure out, hopefully you can see this. I don't see it on my end. 25,000, I'll just say what I'm typing here. 25,000 times 0.02. Remember, calendars are a 2% allocation. I have $500 to work with. Let's see, because this is just sitting here, but let's see how to open a calendar. So you go to the add simulated trades. I'm sure your platform, whatever you use, is going to be quite similar, but you just go to the trade tab. I'm going to find the strikes that I'm using. So if you follow the emails, it's basically pretty simple. You're going to sell the 15th of August and you're going to buy the 19th of September, 308 puts. Now, again, it's going to build it for me. This is not overly difficult, but I'm going to basically, first of all, find that 15th of August, because this is going to be the short month. And I'm going to find that 308, and I'm just going to buy a calendar. And when I click this, it's going to know what I mean by a calendar, right? But obviously, if you're using a different software, you're going to want to check these. So just make sure that the one that says a minus is the August and the one that says a plus is a September. Again, it's going to know how to build it for you. And once you do a couple of these, you're just going to go through this in 1 minute. But I'm going to go super slow. Then make sure, of course, you're using the 308. Then we have to do the allocation sizing. So I've got $500 to spend. And right now it does look like the premium is about $1.75. So if I take my 500 divided by 175, the reason it's not 1.75, by the way, is because one option contract is equal to 100 shares of the underlying. So you just times it by 100. Eventually you'll do this all in your head. It's really a breeze. But again, 2.86. This is going to be a problem. And this is the live trade, remember. So in this case, I am going to be a stickler and I am going to do 2 contracts. So what I would do is I would go 2 contracts. And now we do something called the 30-second rule. This applies to all option trading, not just calendars and iron condors. The 30-second rule, I believe, has a separate video somewhere here. Trade execution and the 30-second rule, lesson 9. See, there's a video for everything. I think I did a pretty decent job of that course where every general question that you're going to have has its own dedicated video in there. But the 30-second rule is essentially just how you get good fill prices. You don't have to sit in front of your computer all day long. These are computers. They kind of match up prices pretty well and pretty fast. It happens like lightning. But you also don't want to always just pay, you can see down here the mid and the natural. If I went to $1.85, I might not get the best fill price, right? So 175 appears to be what the mid is, but there's nothing wrong with trying to get a little bit better, right? You don't have to nickel and dime everything. Just get your trades done and move on to the next trade. But nothing wrong with trying for a little bit better. So the 30-second rule, I'm going to input a price slightly better than I'm expecting to get, and I'm going to wait 30 seconds. So $1.75 for a debit spread, it's actually beneficial if I pay less as a debit spread. If you're selling something, you want to sell it for more. If you're buying something, you want to buy it for cheaper. So I don't want to pay $1.75. I might want to pay $1.74. Let's go ahead and see. And like I said, somewhere on here, there's my account number. I don't care, whatever. Let's see. So it's saying the mark is $1.75. And right now I'm trying to get $1.74. So I would just wait 30 seconds, maybe 20 seconds. Like I said, these are computers. They're really, really fast, but it's a live stream. So I'm just going to go ahead. All you have to do is just change the order and just click it up one, right? Let's see if I get this one. 175, and I did. So maybe I would have gotten $1.74, but I had to pay $1.75. Just don't go in there with the natural, if you're buying something, don't go just on the bid or the ask. Try to get close to the bid price. But like I said, every single thing we trade within the VTS community is highly liquid, always highly liquid ETFs and options. We don't do any low liquidity things. It's a problem. So that's it. The trade is done. I believe I already executed one before, and I believe it was even the same price. So let's clear all these out and let's look at this trade. So this is the calendar that I just opened. First of all, I will ask everybody, and again, feel free to put your questions in the comments section, but pretty easy, right? Like I said, I could have done that in about 30 seconds, but I want to give everybody the full details, and then you're going to get much, much faster as you go. Terrible cup here. Airbnbs, what are you going to do? Yeah, so any questions, put them in the chat. But let's just look at this trade really quick. Just talk about a few things. Remember, it is quite an efficient trade. So I didn't allocate very much capital. The maximum loss in this case, it's actually half this with the official trade, but I'll just divide these. You can see over here, it says 700 right there. It's actually 350. $350 on a $25,000 portfolio. It's not a huge deal if you get several losses in a row, but it's enough to be a decent strategy. And the Iron Condor strategy, actually, long-term, it entered the portfolio in January 2012. So it's actually been live within our portfolio for it's July, 13 and a half years now. And the annualized return is about 16%. And the maximum drawdown is about 15%. So it's not going to blow the doors off performance-wise. Tactical volatility is pretty close to 30% a year. Defensive, the same, about 30. And then these ones are closer to like 15 or 20. That's why, like I said, for people who think, 15% a year sucks. Well, no, it doesn't. That's actually really good, especially if the drawdown is equal to the rate of return. If you can make 15% a year with a 15% maximum drawdown, you are killing it, right? That is actually really good. But of course, with Twitter and the fake gurus that post all these things, standing next to Lamborghinis or going on expensive vacations, they skewed everything. And, now people look at 20% a year like you're some bum, but it's actually pretty good. But if you don't like that, then of course, these ones are closer to the numbers that people would probably be interested in. I personally, just full disclosure, I trade every strategy that you've seen. I trade a diversified portfolio, all of these strategies, plus about 8 option strategies. Everything you've ever seen me introduce at VTS, I trade with my live money. So you can do what you want. but that's what it is. But like I said, it is actually a big enough allocation to make a difference. So don't be thinking that, oh, that's, you're only going to make $300. It's actually a pretty good trade. We just churn higher trade frequency and it all works out. But again, what we're trying to do, so you can see the break evens were roughly 298 and they were 322. So if we were to look at this trade now, this one, nope, let's remove that. 298 to 322. It's about, actually the low break even, practically speaking, would be about 290, and it wouldn't go up to 322. It'd probably drop down to about 318, something like that, 319. We'll just call it 319. It's actually something like this. This is what the trade looks like. And you can see the goal, GLD gold, hopefully in 20 days or so, it is somewhere within this range. Because we use the stop loss and the stop gain, this trade is never going to make it the full expiration. You can see there's 45 days to expiration. This trade is not going to be open longer than 15 or 20 days, maybe 25 or something like that. But it's going to hit either the stop loss, it's going to hit either one of these points. Maybe gold makes a big move and we lose in this trade, or again, we just capture that slow ticking up theta. This pink line day after day will just get a little bit higher, a little bit higher. And when it reaches a sufficient price, we're going to take our 25% stop gain. Of course, I will send that out in the daily email, so you don't even have to take care of that. That's kind of the point of me being here, is that I'm going to be entering and exiting the trades and telling you how to do all this. And anytime it's kind of, an option trade, you can see I show the trade, the option sizing, how to calculate this. Again, you could, after 2 or 3 trades, you'll do this in your head basically, but people are intimidated, so I go over it. It is basically a pretty simple trade. So that's it. That's all I really wanted to highlight, is that there's really only 2 differences between calendars and iron condors. The first one is that the iron condor is vega negative, short volatility, and calendars are, at the very least, you could say vega neutral. But the way that we trade them, closing them out really quickly, like 25% stop loss, stop gain, they actually behave as a little bit vega positive, which is good. It adds diversification to the portfolio. And the second major difference is that calendars are actually more efficient than iron condors, just capital wise. So we have to make those 2 small adjustments. You have to basically go down to 2% allocation from 3, and you have to use 25% stops instead of 50% stops. Easy stuff. All right. So now you are, oh my God, have I been yapping for 45 minutes? I'm sorry about that. I usually try to keep these types to 30. Yeah. And now that I'm doing all the wavy stuff, I think what I'll do is I'll just rip through some questions really quickly and then maybe go for a run. It's almost 10 o'clock at night here in Dubai, and I got really fat in France. I took my wife we did everything. We went to the Champagne region and we did every wine tour imaginable. We toured the cellars of every winery. We did, Tattinger and Renard and, I don't know how to say these words, Veuve Clicquot and all the Veuve Clicquot, however you say the French. We did all of these things. Bollinger, we did Moet, we did Dom, Perignon, we must have done 15. And every time you do the tour, after the tour, it's like an hour and a half tour of the cellars. They teach you their specific way of making the champagne. And then you go up, you do a bunch of tastings. We literally drank, I shouldn't say this. I think it's not cool these days to drink. A lot of people are saying, they don't drink anymore. The wife and I do like champagne and wine. We drank every day, at least a bottle apiece. And it was a mess because, of course, when you're drinking, it's not good enough to just have a bottle of champagne. You also have to have all the food. So, maybe I should I'm back in Dubai now. Maybe I should act like a normal human and go get a workout. But let's go see how badly this looks if I'm moving around, bothering everybody. All right. Greetings, volatility nerds. Yes, volatility nerds. I know my live streams are boring, but this is fun stuff for me. And I know there's got to be a dozen people in the world who also think this stuff's pretty cool. You can lower resolution to 7. I tried that. Actually, the Airbnb, I did an internet speed test. It's fast. It's just as fast as anywhere else. This should not be happening. So I don't know. I just unpacked. I mean, I don't even know you can see them. Behind where I'm sitting is a stack of suitcases. So I did a pretty decent job hiding it all. But I haven't even unpacked yet. I just got the gear out, did a live stream. So hopefully I think I'm planning to do one this Friday, maybe next Monday, but hopefully I get this figured out. Okay. How does a sharp increase in implied volatility close to expiration affect a reverse calendar put spread strategy, considering that the short option decays faster than the long option? Yeah, good question. So for me personally, I don't let option strategies like this get close to expiration. The problem is, and again, getting into the Greeks, you don't really have to know these, but the gamma and then the vana, you're talking about something that gets really hypersensitive the closer it gets to expiration. And of course, with a calendar, you've got 2 different months to deal with. So the short is going to behave, it's going to react a lot quicker than the long does, because the longer dated, it adds, the way we do it, another month. So it's going to move a little bit slower. So yeah, it definitely, what I call dancing on the gamma knife edge. You probably don't want to let your option trades get close to expiration unless it's part of your strategy. So for me personally, I trade multiple option strategies. For example, the Wheel of Fun, when I'm selling puts on VXX, UVXY, that is a strategy that's designed to take things into expiration. My VIX option strategy, monthly cycle, probably about 20 to 30 trades layered on top of each other. It's designed to take it to expiration. Iron Condors and calendars, I would strongly suggest you don't do that, because just if you know, in order to build Iron Condors to the point where they are high probability and you're going to do well long term, they're always going to look skewed, right? You're always going to be able to make less money than you can lose. And with calendars, it's not visually the same thing, but in a practical sense, it's the same thing. You can lose pretty quickly with these things. So the closer you get to expiration, the faster that you can lose whatever profit you've accumulated. So yeah, did I lose track of your question here? Sorry about that. But my overall point is, it's just not a good idea. So that's why I always implement the stop loss. For Iron Condors, a 50% stop gain and stop loss, this basically does 2 things. One, it gets me out of the trade sooner. So I don't take an Iron Condor anywhere close to expiration. Within about 27, 28 days to go, all trades are closed. All right, so we're not going to deal with that increased gamma and that risk. If you're 2-3 days in or 5 days in, day to day, this thing can change a lot. Gamma is the rate of change of delta. Delta is the price changes. So as that price is moving around, you're talking about your trade maybe gaining a lot in a short amount of time, which is great. But I always view things from the risk management side, losing a lot very quickly. You want to avoid that. But the other thing that the stops do is it makes the trade roughly 50-50. And now I don't care what the shape of this Iron Condor is. I don't care that it looks like I can only make this much and I can lose this much, because I'm using a 50-50 stop loss, stop gain. So I'm going to gain and lose the same amount of money. This is a 50-50 trade. So I just open really wide wings, really long dated, and it's a 50-50 trade. All I really need is more winners than losers. And there is trade fees involved. So you need, additional winners to losers. And sometimes losers can run a little bit past the stop loss. So you need additional gains versus losers. But, something like a 60-40 ratio of winners to losers, and you're at the very least going to break even. So I would strongly suggest you do that. Anytime you're trying to take options close to expiration, it better be factored into your strategy. Otherwise, kind of a rookie mistake. All right. I understand you trade 0 DTE outside the VTS portfolio. To me, commissions and spreads seem to greatly reduce the profitability of 0 DTE options compared to 1-month options. A penny for your thoughts. Yeah, I do a lot of 0 DTE trading. I will introduce some of the strategies that I've had the most success with when I do get the VTS options course relaunched. It was, we did options for years and then I had to close it down because I got too busy. Kind of a good problem to have, but at the same time, it cost all the people that loved our old option strategies, and they've been waiting a few years. So I gotta get on that and get it relaunched. But what I would say, it's kind of similar to what Iron Condor traders say to me. they always say, well, when I'm trading iron condors, the trade fees are so high, right? It's a 4-leg option and you're paying for the contract. Seemingly you're paying a lot. What I would say is you want to accurately track your performance and obviously include all fees and commissions and dividends in your performance. With the VTS performance that you see, it always includes all fees, all dividends, everything exactly. So it is the realistic. When I say the strategy makes 15% a year, that's not 15%, but it's actually going to take a 3% chunk out of those trade fees. It's not that, it's after fees. So all you're concerned about, who cares about fees? It's part of trading. When you're trading options, you can't avoid the fees. So just put it out of your head and track your performance. If the strategy itself, including fees, is worthwhile putting into your portfolio, then put it into your portfolio, regardless of how expensive the fees are. If it's not, then don't. So the Iron Condor strategy, it's totally worth the additional fees for me because I've been tracking it accurately for 13 and a half years and I want it in my main portfolio. So that's what I would say is that it's the cost of doing business. And of course, the obvious benefit to zero DTE trading is that, as I always say, small trades, high trade frequency is what good option traders do. Rookie mistake is opening these big trades. So you see these people sometimes selling Iron Condor communities and courses and gurus doing weird stuff. They'll say stupid things like, you can make 5% a month income trading iron condors. And what they're essentially meaning is, if you want, you can set up an iron condor so that if it makes money, you'll make 5% that month. That's what they mean. It's not hard to do that. You just take a very large position size, and if it wins, you'll make 5% that month. Okay, what if you lose? Oh no, we don't count that. In the fake trading world, we don't count losses, right? So they don't do that. But the second thing is, we're talking about income. It's so inconsistent over time. So I always say small allocations, high trade frequency. That explains zero DTE almost exactly. So the benefit is you can take 1 million small trades over very, very small time horizons, and all you have to do is find a tiny little edge in the market, and then you just amplify it to the extreme. But the flip side to that is, yeah, it's going to cost you a lot more money in fees. So again, I get back to the point that all we care about is performance, including fees. Does that fit into your portfolio? Yes or no, full stop. Don't worry about the fees. You pay the fees you pay. It's the same reason why I tell people, you got to be careful trading within like 401ks and within tax sheltered accounts, because some of those things don't allow you to do the good strategies, right? You don't want to limit your choices because you're trying to navigate around tax reasons. Like, just trade what you trade, add it up, take the tax hit, and see if that is better than this. That's all we're concerned about. So I don't even look at the fees. Now, I will say, of course, there's benefit to looking around for a broker that will save you the fees, right? Don't just pay high fees just because. And if you're European, I apologize because your fees are probably quite insane. But yeah, fees are just part of trading. Just do the best you can to reduce your fees at the broker level and then trade the best strategies you've got, right? That's what we should be doing. Okay, when are you going to update the data spreadsheet? Good question. At least as far as I can see, it ends December 2024. Uh-oh. Q2, you can add the VTX crush indicator. So I think what's happening here, you're not the first person who said that it hasn't been updated since last year. It actually is updated till recent, but there is one link floating around somewhere. I must have shared it somewhere on a YouTube channel or somewhere inside the course somewhere. And it's a link that doesn't update. It's just a static link that is not updated since I released that last spreadsheet. But yeah, the next live stream I do, I'm going to update the spreadsheet, talk about any changes that I made, and then highlight where people can download it for free. So this is definitely coming within a week. I promise you. I should never use that word promise. I'm so busy that sometimes I, renege on them and then I feel bad. But yeah, it's the very next live stream is going to be the spreadsheet update. For anybody who doesn't know what we're talking about, there is a free data spreadsheet that has all the volatility metrics, all the VIX futures. It's got a bunch of crypto stuff and Bitcoin comparisons and a VXX price calculator, and it's got a bunch of stuff that you'll probably want if you're a trader, right? You've got to know the VIX 9D to the VIX 3M. You can't get that data. I've been tracking this stuff for 20 years, so get it from me and get it for free. Never pay money for what you can get for free. This is why I go in so hard on these gurus that talk about stupid shit like selling covered calls and buying leap options and doing all these things that you can learn that in 5 minutes on 1,000 different free YouTube videos. Don't ever pay money for someone to teach you how to sell covered calls. It's a ridiculous strategy that doesn't work, obviously, right? Just think about it for a couple seconds. You're capping your max gain and you're not reducing your downside. Why would anybody do that? But secondly, it is so utterly simplistic that I cannot believe there's people paying even 1 penny for that information. So don't do that. And don't pay money for a spreadsheet for volatility futures and metrics because you can get it for free from me. Okay. What clues do you gather to establish and estimate that prices will stay in a range? None, but that's a really good question. It is answered at some point in the course, but like I tried to illustrate, and I probably just glazed over it, none of us know, right? I mean, if we're going to pretend that, what's that sound? Somebody's moving furniture outside. If we're going to get into that game where I'm going to tell you, here's what I'm going to do because gold's going to go up. I don't know what gold's going to do. I just know that I have built a portfolio that I don't really have to know what's going on, do I? Tactical volatility strategy is going to be short volatility during mid to low. It's going to be in safety gold during mid to high. And it's going to be long volatility in extreme levels. That's all I have to know. I don't have to tell you when any of those are going to happen. I just have to know how to react when it does happen. Strategic tail risk is going to be in the S&P 500. It's going to be in the IYR most of the time for our safety position. Occasionally, it'll be in Coca-Cola. And then long volatility, it will be replaced by the chaos ETF. I don't have to know when that's going to happen. I don't have to predict the next market crash. I just know when it happens. I'm going to be in long volatility, I'm going to be in cash, and I'm going to be in the chaos ETF. When the crash happens, I don't know when that. Maybe tomorrow. Maybe Trump's luck is going to run out and people are going to be like, he said this yesterday and he said this today and we're finally going to sell off. But maybe it'll happen in 2 years. I don't know. But I don't have to know. And for iron condors, I strongly suggest you don't be that trader who's trying to predict markets. Like I said, low or high trade frequency, smaller position sizing, layer as much as you can, and just churn. The rest of your portfolio will handle it when you're in stronger trends. You would never structure a portfolio to where your iron condor strategy is larger than all of the other strategies in your portfolio, because there's going to be times when you're in a strong trend and iron condors are going to get stopped out just constantly, not constantly, but you might get 3 or 4 losing trades. In that case, you'd certainly want to be net long equities, probably with some leverage to cover for that. If the market's crashing, same thing. You'd probably want to have metrics that get you into long volatility, into cash, into bonds, into chaos, things like that. And the iron condors might lose a little bit of money. So you don't. I didn't take this trade today because I'm anticipating gold is going to pin at 308 for the next 2 weeks. That's not why I took the trade. I took the trade because I've already got one open. The price has deviated a little bit from where it was before. So that's all I do. Let me go on a little bit of more of a tangent here and give you a slightly better answer. But my iron condor strategy is basically designed around what I call 5-point diversification. So the first level of diversification, like I said, there's 3 different positions available here. And the first one is price. We don't double up on the same positions. I already have a QQQ iron condor open, right? I've already got this trade open live in the portfolio. It's basically flat right now, but it's deviated. I opened it when it was here and it's now over here. Well, if the price was here, I would never open another trade. That would just be doubling up on the same trade at the same price that I already had open. The reason I'm open today to open a new one is because the price is all the way up here. It's not costing me anything yet, but this opens up the diversification aspect of I'm opening at a different price than my previous level, right? Layer 1 was at a different price than layer 2. Time, right? Layer 1 was opened a couple weeks ago. Now a little bit of time has passed, so I'm going to add another layer. Not because I know where gold is going to go in 4 days, but just because I'm diversifying across time now. By strategy, we use both iron condors and calendars. That's a little bit of a change there that allows for some good layering. Over volatility, we enter trades across various ranges. When I opened that original QQQ trade, volatility was up here, right? Now it's down here. So I've diversified over 2 different volatility ranges with 2 different trades. Both of these trades are different across price, strategy, asset class, or the 5th one, I should just highlight that really quickly. Asset class, right? We don't always use stocks. We can use bonds, gold, utilities, real estate, etc. These trades are layered across multiple different diversification tools. So it's 5-point diversification. Now I just have to layer small positions over and over, layer them on top. Try not to react to your gut instincts. We are quant, systematic, rules-based traders. We're not just, hey, I think that's going to go up, so I'm going to buy a leap option. That's going to fail, obviously. You follow those gurus long enough, you start losing your money real quick. So we don't do any of that. We just design a portfolio that can handle what the market throws at us. I don't know what the market's going to throw at me, but I know my portfolio can handle it. That's all I can really do. Hopefully that answered that question somewhere. I should probably shut this down. I can see myself just skipping all over, and it's annoying me. I'm kind of a perfectionist, so to speak, and this is really bothering me. And I don't like being fat, so I should go for a run. Even though it's going to be 11 o'clock at night, I should still do it. Yes, and this wasn't updated because I was in France. I was, drinking champagne and traveling around. And I do work when I'm on vacations, but I work less, right? I probably only put in about 6 hours a day, and I definitely double that most of the time. So this was one of the things that just chopping block. But yes, I will update both the spreadsheet, I will update performance, and I haven't seen it yet, but I will probably also answer some emails that have been piling up. So if you're a person that's kind of waiting for an answer, you might get an email from me just out of the blue tomorrow, and you think, I asked this guy that question 6 days ago. What's going on? Well, what's going on is I drank too much in France. So apologies there. In trading volatility, high volatility days are likely to happen next to each other. I feel like this is almost a law of the universe, as it's true in many different domains. The worst days of your life are probably also sticked together in small time frames within your life. Well, I experienced that last part big time. Maybe one day I'll get into what happened to me sort of 2010 to 2012. Yeah, boy, that was life beating me up constantly for a 2-year period, just relentless beat down. So I kind of agree with this, but what I'll alter it a little bit. The best and worst days tend to cluster together, and big volatility spikes and big volatility crushes tend to cluster together. I think that's more accurate to say. It's actually quite rare to get consistently large volatility spikes like back to back to back to back. What happened during COVID was an anomaly for sure. But what typically happens is the market reacts to something, and I should say overreacts to something. And then the next day they parse through the data and they realize, well, this isn't really a big deal. And then you get a big volatility crush the next day. So I would say that the best and worst days cluster and the best and worst volatility spikes cluster. That's probably more accurate. I wish life for me during those year or two period was like that, because I didn't get any wins in the meantime. It was just big losses. No fun. Have you considered adding chaos versus cash in the defensive rotation for those that follow the aggressive portfolio? Curious if it has any impact. So this portfolio For safety is gold, or sorry, this strategy, tactical volatility. And then for extreme, we do long volatility. For the defensive rotation, it's utilities for safety when the market's not fully falling off a cliff yet, and then full on cash about 10% of the time when the market's just too volatile and we just sidestep completely. The strategic tail risk moves to the IYR, like I said, most of the time. As long as interest rates are either stable or going down, IYR behaves really well as a safety position. If interest rates are going up, then that's not going to be good for the IYR, and we would be using Coca-Cola in the meantime. But chaos, the chaos ETF, this is about a 7% sliver in there. The only reason why I wouldn't put chaos in here is kind of the same reason that I always tell people. I don't really care how good you think your strategy is, and I don't even care how good it's actually performed. You never over allocate to anything, regardless of performance. Like my tactical volatility strategy was crushing it for like 12 years, right? You don't over allocate to something just because it's doing really, really well, because you don't know the future. You don't know if that's going to stop suddenly. You don't know if the market's going to change. So you never do that. Even though it's tempting, the Chaos ETF, when I look at it as a safety sort of extreme position, it checks all the boxes of what I would be looking for. But the point is, I don't really know what the future holds. So I just have to accept that it's only ever going to be a 25% allocation to my portfolio. I can't put it up to 50. That's just too much. Maybe I come back 10 years from now and I run the backtest numbers and I say, I probably would have been better off putting chaos at 50%. But I just don't trade that way. I have rules and I don't break them. Bad things happen when you break your trading rules. And so, no, this is one of those, certainly in the last 4 years, this might have improved performance a little bit, but it's still a no. That would be an over allocation to something. So cash, the defensive rotation certainly doesn't need any help. It's the performance is in the 30% or higher range annualized. I mean, I think it made 88% or something last year. So it doesn't need any help. I would just leave everything as it is. All right. I have got to get out there and go for a run. So hopefully I explained everything clearly, and I'm going to chop that section up because I do think it's important, and I'm probably going to post it on the YouTube channel, and I'm also going to post it in tomorrow's email. So hopefully, you understand everything and you took the trade, one contract size if you're new, and fingers crossed. Remember, I don't know what gold's going to do, but it's definitely a good trade in this moment. And I'll track it. I'll come back and update. And like I said, the spreadsheet update is coming in the very next live stream. So subscribe to the channel and you won't miss that one. See you next time.